Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Joseph Sitch. Joseph is the Co-Chief Investment Officer of Equities for the Victor Smorgon Group. Joe, thanks for sitting down with Livewire today.
Chris, thanks for having me.
Of course. The automation sub-portfolio, it's grown from 3%, now 21% today, so a big chunk of the portfolio. What's driving the conviction?
With any theme, we let things earn their right to grow. So this is something, industrial automation, that we've tracked as business operators in some of our private businesses for a number of years. That's where the theme was originated. In some of our agricultural investments, we implemented industrial automation kit, and that represented a really strong return on capital. And we thought, if it's good enough for us, it's going to be good enough for a number of others. So that's one part of our investment process. From there, we try to think about what parts of the industrial automation complex, who has the operating margin and who has the leverage to charge higher prices. That took us to a couple of main segments. The first is the power providers and the electrical infrastructure providers. The second is who's providing the compute. And the third is who are the applications and the installers. And really we've invested in all three at different periods of time. And really we have the battle for capital, investing in what the best value is and who's growing their earnings the fastest. That portfolio has been very strong, and each year it's competing against the rest of the portfolio. The theme continues to be robust. The demand side of things and installation side of things remains strong, and the companies keep delivering. That's why it's continuing to grow, and currently combined electrical infrastructure and automation is the largest theme in the fund.
Yep. Just to follow up there, if I may, I mean 3% to 21% is quite a sizable shift. Not asking you to crystal ball anything, but do you anticipate, given it's such a strong theme, it could continue to grow and become a larger part of the portfolio?
So we debate that internally a lot,
right.
and we really are tight on our risk in terms of what does taking it from 20% to 30%, what does that do in terms of our expected return and our incremental volatility that we think that attracts. This year we have split out industrial automation from electrical infrastructure, and the reason for that is the companies tend to report earnings and earnings growth at different times, right. And they're actually quite uncorrelated to each other over a rolling 3, 6 and 12 month period. So that gives us the confidence to split them out into discrete themes and potentially increase the weightings in both over time. Right. But we continue to do this slowly. I mean, 3% to 21%, that's taken us 3 years to do, having taken 3 years of investigation before we invested in the theme at all. Right. So if we were to increase it from here, I would say it would take another year or so.
Yeah, for sure. What kinds of companies, Joe, do you invest in within that automation theme?
So it was a little bit like I outlined before, the three key segments. So in the electrical infrastructure, cable and wiring side of things, that's a company like Prysmian and Hitachi. Hitachi, ironically, actually have another business, which is the second component, which is the industrial automation installers and service component. Of the companies that install and have automated solutions, a number of those have really strong software components. And we've seen that with Hitachi. They've got a Lumada business, which has really improved their operating margins, and that's helped them take the return on invested capital from 4% to approximately 9.5%. And that's translated to effectively earnings dropping to the bottom line. Hitachi have outlined that they want to continue to increase their Lumada usage and their software solution because it's very high margin, and that's what we're seeing for the next future element of growth. The only final element that I would talk about is who has dominance in the chip infrastructure side of things. These companies are very well known now, and you have to be quite contrarian in terms of finding entry points, but ASML is a company that we've owned over 5 years at various periods as it presents a margin of safety in multiples. And that's the overlay because we think of our investment like business operators. We don't want to be paying 20 and 30 times earnings, albeit for growing businesses. ASML has presented over the last 4 years 3 opportunities to own it in the low to mid-teens whilst earnings are growing strongly.
Yeah. Any other companies that you could talk to, Joe, just to highlight the way you think about the space?
So in the chip space, we've also owned TSMC as the dominant sort of fabricator in the market. We think ASML from a lithography perspective has a real monopoly in that space, and there's really strong order book demand for that company. From a application layer and the service, that's companies like Caterpillar and John Deere. They're really similar to Hitachi, as they were traditionally known and owned as boring construction machinery businesses. And their software solution and the automation component of their business, which they are dominant in, those two businesses in particular, that's translating to incremental revenue growth, but more importantly, operating margin improvement.
Yep. Joe, we've spent a bit of time on automation. Let's shift gears and focus on one of the other themes, gold. Now, it did pretty well for you in FY25, added 6.4% in terms of return to the portfolio. As you would know, the gold price is near record highs. So what's the ongoing case for gold and gold miners?
Yeah, so gold was a really strong performer for us last year. And we think when we look at our thematic framework, we always go back to what are the data points that inform us being there. Yep. So the unsustainable debt levels in the US, yep, we're at the point where government interest and entitlements in the US is exceeding the receipts from taxation. Yeah. And every time that's happened in history, there has been a revaluation of gold over time. We've also observed in, let's call it the East, there has been increased utilisation as gold is probably a net settlement. If we had have sat here 5 years ago and said that China are going to be purchasing commodities and real assets using the yuan and India using the RMB, as opposed to the US dollar, we probably would have thought we were from Mars. Yep. But here we are today, and we think gold is being used as a net settlement, right, in that exchange. So they're 2 points that we're watching very closely. The third is what are the central banks doing? In the historical gold bull runs, central bank buying has been probably the marginal demand, which has increased the price over time. And for the last 3 years, central banks have been there at strong rates. It'll be interesting to see that continue, and that's something we're watching. On the company side of things, what's really important to us is seeing operating margins improve. Mm-hmm. You know, if the gold price is up 30 to 40% year to date, these operating companies are leveraged to that. Their earnings should be materially higher than 30 to 40%. And really that comes down to which management teams are good capital allocators and they return capital to their shareholders. And that's something that we're going through. There's a material premium to companies that do right by their shareholders versus companies that are just leveraged to the gold price. And our focus, given that we have the operating skill set, is working with the best management teams in jurisdictions like Australia, like Canada, where government risk isn't as high. Yep. We think today there's a robust investment case still in the gold, but we're closely monitoring that operating margin and the gold thesis itself.
Yep. Any names that you can give us?
Yeah, for sure. So Ramelius has been an excellent capital allocator for a long time. So that's in the Australian market. Mark Zettner, the managing director there, has done a terrific job in purchasing assets and actually returning capital from those purchases over time. He's made over 4 asset buys. All of them have been accretive. We believe the Spartan recent acquisition is misunderstood by the market, and we think that'll be accretive into the future. Going to the US, we're really excited about Equinox as a turnaround story. There is some development risk in that price right now, in terms of the market is not assuming that they're going to get there smoothly, and as they get into more stable production, there's a really material re-rate there into the future. Yep.
Joe, talk to me about the best ideas portfolio. When I was reading about this, I'm absolutely intrigued. So it's been a big driver of the overall fund return. So what makes something a best idea, and then how does it differ from the other thematics?
Best Ideas has had a really material part of our returns, but it doesn't get there by accident, as the name implies. So Best Ideas are typically companies that sit within existing thematics, whereby there is a really material inflection point that's occurred and hasn't been reflected by the market. Right. So in the past, that's translated to companies that have just gone into a step change in their operating margin, and they've shown and demonstrated that for a couple of quarters. We own them as existing portfolio companies, but in the context of the overall portfolio, it might only be 3 or 4% of the fund. Right. That might not be enough given the risk reward is so strong at a point in time that the market hasn't recognised that inflection and catalytic change. Yeah. So it's at that point where Peter and I, who sit across everything, look at the themes and say, yep, the thematic allocation is correct, but we've got this opportunity in electrical infrastructure, we've got this opportunity in our gold sub-themes that are really excellent risk returns. And at that point, it's not how many times you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong.
The Soros quote.
And of course, we look to try and maximise the opportunities when we think that there's a real material opportunity.
Yep. Can you just give it an example, Joe, of one of those inflection points that you're talking about? Has there been a company in the past that you've seen that opportunity and nailed it?
Yeah, so Hitachi absolutely has been one of those. That was a company that was branded as a more boring construction machinery business. Yep. It sold 10 business segments and really focused on 3 elements. their electricity grid and power grids business, their energy side of things. They bought a really excellent nuclear manufacturing business out of Westinghouse. Then the third is their industrial automation solution. Over the top of that, they implemented a software package, Limada, and really that showed and drove their return on invested capital to go from 4% to over 9%. That was translating for a number of years before the market took notice of it.
Right.
And we thought that the key catalyst was the final set of accounts going from the old Hitachi to the new Hitachi, focused on where we think the themes are in the world. And whilst there was very strong earnings growth throughout the last 4 or 5 years, it was only when that balance sheet and earnings story became clearer that the company got a material multiple re-rate. So that was at a point where it was a key component within our electrical infrastructure and automation sub-theme, and we upped it in best ideas at the appropriate time.
Joe, thanks so much for sitting down with Livewire and taking us through that.
Thanks for having us.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.